me ask you a question. What if the reason your money keeps hitting the same ceiling is not that you lack effort, but that your credit is only being used to survive? The system may be reading you as a borrower, not as a financial position. I've spent decades watching how banks read credit, income, balances, and timing. And the part most people miss is this. Credit is not only about whether you can borrow, it is also about how the system positions you for your next financial move. So today I want to show you what credit leverage really is, what it can create, and what it is not. Because the truth of the matter is a higher score does not automatically create wealth. I will show you the 3 places where credit can change your position: access, timing, and costs. Then I will show you the boundary that keeps credit from becoming another trap. First, let's talk about the real problem. Credit is more than a score. A lot of people look at credit as one number. Maybe it is 620, maybe it is 700, maybe it is 740, but that number is only one part of the picture. Your credit score is a summary. It is a quick way for the system to measure certain parts of your past credit behavior. Think of it like this. They're checking to see how you manage debt. It may reflect things like your payment history, your balances, the age of your accounts, and how much credit you are using. But your score is not your full financial position. Your full financial position includes the whole pattern. It includes what accounts you have, how much available credit you have, how much debt you are carrying, how your balances move, how your income connects to your obligations, and what kind of financial activity the system can see. Credit scores do not just respond to effort, they respond to data patterns. You can work hard, you can pay bills on time, you can earn more money, and you can still receive weak approvals because the system is reading pieces of your financial life instead of the full position. Now, that does not mean a credit score is not important. It is important, but it is not the whole story. A stronger credit position may create better options. It does not guarantee approval, though. That distinction matters because the system may approve you for one thing while still limiting you in another area. So when you think about credit, do not only ask, what is my score? Ask, what does my entire credit position say? This is important. Now, what credit leverage really means? We're going to talk about that. Credit leverage means controlled access to financial options. That's the key word, controlled, not careless, not emotional, not borrowing just because a bank says you can. Controlled access. There are 3 parts to this. Part 1, access. Credit may be creating access to capital, business tools, important purchases, or opportunities that require available funds. But access is not free money. Access only gives you another option. Let me say it again. Access is not free money. If a bank gives you a $20,000 limit, that does not mean you created $20,000 in wealth. It means you now have access to a financial tool. The value comes from what that tool helps you do. And whether that move makes sense is all important. Part 2, timing. The second part is timing. Sometimes the problem is not that an opportunity has no value. The problem is that your cash is not available at the right moment. A strong financial position may create more room to manage that timing. For example, a business may need equipment before the next payment comes in. A property owner may need to make a repair before the next rent payment arrives. A business may need to pay for an important service before the client pays the invoice. Credit may help create room between today and the next cash event, but that only works when the repayment path is real. If the money is not coming back, then timing is not leverage, it is delay. Part 3, cost. The third part is cost. Credit can affect the cost of moving money. Stronger positioning may help you qualify for better terms. Weak positioning can lead to higher interest, higher fees, and more restrictions. And higher interest can erase the value of the opportunity. The real lesson is this: leverage only helps when the cost does not destroy the result. If you borrow $10,000 to create a $2,000 benefit, but the interest and fees remove that benefit, then the position did not help you. It hurt your cash flow. So credit leverage is not about borrowing the most. It is about using the right amount for the right purpose at the right cost. Now, the same person but different positioning. Let me give you a quick story. Imagine two people. They have the same income. They have the same work ethic. They have the same goal, and they have about the same level of financial knowledge. But their credit positions are different. Person one has high balances. There is very little available credit. Personal spending and business spending are mixed together. There is no clear plan for using credit, and the person is making payments, but the cash flow still feels tight. Person two has a more organized position. The balances are easier to understand. The available credit is protected. Business and personal activity are separated more clearly, and every use of credit has a reason behind it. Now, these two people may look similar from the outside, but the system may read them very differently. One person may appear to be under pressure. The other person may appear to have more room. That does not mean person two is richer. It does not mean person two is guaranteed approval. It means the position gives person two more choices. Same person, same habits, but different positioning. And trust me, it makes all the difference. The credit position did not create wealth by itself. It created more room to make a better financial move. This is the part many people miss. They think the goal is simply to raise the score. But if the score goes up while the financial position stays weak, the problem may still be there. A number can improve while your options remain limited. So the question is not, how do I get a higher score? The deeper question is, how do I build a position that supports my next move? Now, let's look at what credit leverage is not. We got to talk about this. This is the part that protects you. Credit leverage is not buying things just to look successful. It is not using one card to cover a permanent cash flow problem. It is not taking every offer a bank sends you. It is not believing that a high limit means you are wealthy. And it is not borrowing without knowing the cost. A high limit is not a plan. A low balance is not always a strong position. And a high credit score does not mean every financial move is a good move. Credit also is not a way to avoid the deeper problem. If your business is losing money every month, more credit may only keep the problem alive. If your personal cash flow is already under pressure, another payment may make the pressure worse. If you are borrowing because you feel rushed, the system may be using your urgency against you. That is why you need a purpose before you use the tool. If credit is only helping you delay the same problem, that's not leverage. That is pressure with a new label. And this is where many people get trapped. They see access and think they have wealth, but access creates an opportunity. It does not create a result. The result still depends on the purpose, the cost, the timing, and the plan behind the move. So what a real leverage position contains? It contains 4 things at least. Number 1, a clear purpose. You need to know what the credit is meant to support. Is it helping you buy equipment? Is it helping you manage a short timing gap? Is it supporting a business activity that can produce revenue? The purpose needs to be clear. Number 2, a real repayment path. You need to know where the payment will come from. Not where you hope it will come from, where it will come from. If the repayment plan depends on another loan, another card, or another emergency, the position may not be strong enough. Number 3, a cost that makes sense. You need to understand the interest. You need to understand the fees. And you need to understand how long the balance will remain open. The cost must fit the expanded or expected result. Number 4, a position you can maintain. You must be able to protect the position after using it. That means watching the balances, making payments on time, keeping the accounts organized, and avoiding new pressure that you cannot carry. This gives you the framework, but it does not replace a personal review of your credit, your business, your cash flow, and your goals. Because every person has a different position. Every business has a different need, and every financial move has a different cost. The goal is not to copy someone else's credit strategy. The goal is to understand what the position is saying before you make your next move. Now, it's about credit, business, and life. This is where the CBL Wealth Blueprint becomes important. Credit is one layer, business is another layer, and life is another layer. Credit may affect access and terms. Business gives the money a productive direction. Life determines whether the structure can be maintained. If those layers are disconnected, the same money problem may keep coming back. You may get access but have no clear use for it. You may have a business opportunity but no credit position to support it. You may build a financial structure that looks good on paper but does not fit your real life. So the what is simple. Credit becomes leverage when it improves your position and supports a clear financial purpose. It becomes a trap when it only creates more pressure. Now, maybe the goal was never to borrow more. Maybe the goal was to become better positioned. Credit is not wealth by itself. Credit is positioning. Wealth comes from what that position allows you to do with control. Because the truth of the matter is the same tool can create opportunity for one person and, my God, pressure for another. The difference is the position behind the tool. So you've probably been told your problem is discipline, budgeting, or simply working harder. Those things may matter, but they may not be the root problem. The deeper issue may be a financial system you've not been shown how to see yet. So I built a free tool to help you identify which layer is creating the most friction in about 5 minutes. It's called the CBL Financial Positioning Diagnostic. The link is in the description. Now listen, there is no cost, no pressure, just a lot of clarity. Now, this video helps you understand the what. The CBL Wealth Blueprint helps you examine your full position. It helps you find the main point of friction. Then it helps you build the right sequence for your situation. That includes diagnosis, sequencing, personalization, integration, accountability, and the complete CBL implementation. The free video gives you a clear idea. The full blueprint helps you apply that idea to your actual financial life, because your position is not the same as someone else's position, and your next move should not be based on someone else's numbers. Do me a favor. I mean real quick. Subscribe to this great channel. Hit the like button. Come on, hit it right now if you haven't hit it yet, because I want many people to see this so they'll be on top of this information just like you are now. I stay on top of how the system works so you can make better decisions inside of it. Drop a comment below and let me know. Do you see credit as a score, or do you see it as a financial position? I want to know how you've been thinking about credit. And here's what I want you to remember. Credit isn't just about borrowing money. It's about positioning yourself for opportunity. But opportunity only helps when you understand the purpose, the timing, and the cost. Use the tool with control. Do not let the system turn access into pressure. And listen, my friends, I want you to be blessed and have an absolutely awesome rest of your day. I look forward to seeing you again real soon. You be blessed.